As I mentioned, everyone, my name is Elgin Press, and I am your host tonight for our masterclass. Okay. This class, I want it to be extremely interactive. So make sure you have your thumbs ready to go, fingers ready to type if you're on a computer, and make sure you have your chat box ready to go. All right. I will be answering Q&As the whole time. So it's okay if something pops in your head, even if it's off topic, ask your question. I'll either address it then. If not, my co-host Fernanda, who's joined us, she's gonna go ahead and be making sure that she saves all the questions I happen to miss. Rarely do, but if I do, she's gonna save those for us. Okay. If you're just joining us, please do me a favor. If your name is not showing on the chat box, I think we have someone named iPhone. I really want to get to know you guys. So drop in your name. Fernanda's going to go ahead and update that for us. Otherwise, drop in where you're from and we'll go ahead and get started. Oh, and one more thing before I forget. If you have to leave early, or maybe you have a very personal question that you're just not comfortable obviously asking here in this forum where it's a little public, right, for all of us, that's okay. If you have that, go ahead and schedule an appointment. We're offering a free one-to-one consultation with me. Okay. And Fernanda's going to drop that link so you can schedule that free one-to-one consultation. For some reason, again, you got to leave early or you have a personal question. I want to make sure that all your questions are answered because it is a journey on how to buy a home for sure. And let's jump into it. All right. As I mentioned, interactive. So let's start out with the most important part here. Monique, welcome. Thank you for joining us. Fernanda's going to update your name so I don't have to refer to you as iPhone. Tell me how you guys are feeling right now, man, about this whole process, right? I mean, we have someone that just moved from Miami, someone that just traveled all the way from Texas, and you're getting resettled into different parts. We're all at different stages in life, as I say. But the home buying process, if you've never gone through it before, or even if you have, are you feeling concerned, stressed out, intimidated, anxious, uncertain? Maybe there's other words that I haven't had. I'll tell you, I have some people walking in here feeling excited right off the bat. Joseph, yeah, nervous, right? All of those. I'm going to take Lisa. You said the word yes. I'm going to say that you meant all of the above. Curious and a little bit uncertain. Absolutely, Jessica, right? We're not sure what to do, what to ask. So my goal, okay, I want to make sure you guys understand my goal with you guys tonight. And I tell people it's not to provide you information. And I know this might sound a little silly, but I tell people information you can go gather on your own. You can go online, you can go to Google, you can go to ChatGPT, you can go to all these different places today and get plenty of information. However, what that's not going to give you, it's not going to give you real world applications, how to actually apply that information properly today. And that's where knowledge comes in. So my goal is to actually empower you with knowledge so you feel in control in the whole process. And by the end, you can say, whew, we got this, or you got this, most importantly, because this is about you. Tell everyone I'm in here by myself. Everything's closed. It's 7 o'clock. I really appreciate you guys being here this late. Okay. I do have one more challenge for everyone. So the name of our company is ACE Lending Group. And that stands for Action, Commitment, and Excellence. As I mentioned, my goal is to empower you with knowledge. So I'm going to ask you all for one big favor other than all the Q&As. And that favor is that anytime you learn one new thing, okay, that's all I ask. Anytime you learn one new thing, could you do me a favor and drop the word ACE right in that chat box for me? And can we practice that right now? Monique, Valentine, Lisa, Joseph, Jessica, and Edson. Could you guys drop those words? ACE? Perfect. Awesome. Just like that. Okay. Just like Jessica and Valentine just did. Anytime you pick up one new fact, I get excited. And I know you're going to probably laugh because I yell and scream because I love doing this. So awesome. Thank you, Lisa. Thank you, Monique. Appreciate all you guys' participation. Like I said, my name's Elgin. That's Elyin. I spell it out because, well, everyone butchers it. Eileen, Ellen, Elaine, Elspeth, Edward. I've heard them all. That's okay. Just know that I'm the owner of ACE Lending Group, and I'm here to make sure you succeed. One of our biggest things that I tell people is we don't tell you no, we tell you how. And so a lot of people, one of their big questions is, Elgin, when do I start? Do I start 2 months before I want to buy a home? Do I start 6 months before I want to buy a home? Do I start the month of I want to buy a home? I'm going to tell you right now, I believe if you have the intentions of buying a home anytime in the next 12 months, you should go ahead and be talking to someone. Because the number one thing you want to do is figure out where you're at now. However, who you apply with absolutely matters. Okay. And what I mean by that is that there are actually 3 types of institutions that you could apply with. I don't know if you guys knew this, but you could actually apply with 3 different types of institutions that all offer a mortgage. They're called a bank, a lender, and then what we are, a mortgage broker. And I really need you to understand this part, because based on who you apply with, not only will give you different results, different level of service, but more importantly, it could even be the difference between just getting that yes or no. Additionally, it could mean you end up paying more money than you should have. What do I mean by that? Well, let's talk about what a bank is. And please understand that there is nothing wrong with going with a bank, but you got to understand what it is. A bank's going to be your traditional institution, a Wells Fargo, a Chase, a Bank of America, Truist, any credit union. Okay? And here's the deal with them. They offer mortgages. Yes, they do. But they also offer everything else under the sun. Checking accounts, savings accounts, auto loans. So what does that mean for you as a client? Well, that means that they don't specialize in mortgages. That means that for themselves, they have plenty of streams of revenue. Okay? So they don't have to take so much risk approving clients. They don't have to tailor to that. I'll give you one of the biggest examples I run into all the time. If you've done some research on mortgages, you might have heard of a loan program called an FHA loan. Did you know that for an FHA loan, per actual FHA, meaning HUD, who actually sets up the rules for every bank in the nation, the minimum credit score to get approved, or I should say to apply, to be eligible for applying, is only a 500 credit score? That's right. The minimum credit score to apply is a 500 credit score through an FHA loan. But here's the deal. Most banks have something called overlays. Woo-hoo-hoo! I got my first real ace from Lisa. Thank you, Lisa. Appreciate that. She learned something new, guys. That's the goal here. But here's the other part behind it, Lisa. Is most banks, the reasons why they tell you no, the reason they tell you, oh, we only do a 640 credit score, a 620 credit score, is because as a bank, you cannot go under that rule. Meaning, okay, so if FHA said the minimum score is 500, you can't do a 490 or 480 or anything below that. However, you can set additional rules that are harder to get approved than that. So what happens is most banks will add additional rules. They might say, we won't take anything under 620 or anything under 640. Not all banks do, but most will. And they will do this through different programs. Sometimes they won't even offer certain programs. There are some banks that don't even offer FHA loans, only offer conventional loans. Some banks don't even offer VA loans, only offer conventional loans, et cetera, et cetera. Bam. Sorry, got excited. I saw an ace from Joseph. Thank you, sir. Appreciate that. So that's what a bank is. That's why they're able to do that. Now, the benefit of a bank is they're well established. They got big names. You might know them. The other bad thing with banks, again, is that they don't tailor to this. Meaning, if you've ever applied with a bank, you're going to experience 1 or 2 things on all their products because, again, they don't specialize. You're either going to get a yes or a no. You're never going to get a how. And that's where we're going to be different. Jessica, thank you for the ace. Thank you. Oh, man, we're kicking off real good this evening. I love it. All right, let's talk about what a lender is, because I said there's 3 institutions. So I think we got a good idea about a bank. So a lender is very similar to a bank, where they're big names like Rocket Mortgage, UWM, Quicken Loans, Carrington. So they have big name recognition. But here's the difference is a lender can only offer mortgages. So I tell people, look, you're better off going with a lender if you want to, especially if you're a first-time home buyer, because you are going to get more tailored service. Why? They only offer mortgages. So as a company, they have an incentive to approve people and take on more risk than a bank. So if they're not approving enough people, well, they're not closing enough deals. They're not making enough money. Okay. And I tell people there has to be a win-win. Companies are in it for profit. You're in it to get your home. So there has to be that win-win scenario. Now, here's the deal. With lenders, when you apply at a lender, you're applying at that one particular institution. So they can only offer you whatever they specialize in, whatever mortgages they offer, and whatever rates they have at the time. However, from my experience, lenders are definitely going to give you a little bit higher quality service and hand-holding than a bank will when it comes to a mortgage. And then there's a mortgage broker, which is what we are here at Ace Lending Group. I tell people we're completely independent. We're a middleman. So what we do is with one credit pool, I want to repeat this part, okay? With one credit pool, we're able to shop over 100 different banks and lenders nationwide without any of them having to continue to repull your credit, recheck your credit, because per our contracts, they use the credit report we're providing. And so what that means for you is now we're able to find not just who's going to say yes, but who's going to give you the best terms, who's going to give you the best loan program, who's going to give you the best rate, the lowest closing costs. Okay. Easiest way I tell people, if you've heard of Expedia, we're like the Expedia of mortgages. Woo, I'm getting a bunch of aces. I'm loving today. Man, you guys are making my evening. I love when I'm teaching. I really, really appreciate that, guys. But that's what we do here at Ace Lending Group. So what I tell people is as a broker, we give you unlimited solutions, unlimited flexibility. Okay. So if it's out there, we're able to do it. If it's out there, meaning if there's a product that we can find or an investor or a bank or a lender that's willing to take on your case, we're able to get it done. Okay. And then more importantly, if we're able to find multiple places that are able to take on your case, now we're able to go ahead and shop and pin to get the best deal possible. And that's the difference between a bank, a lender, and a broker. So one of the very first decisions you should be making as a client is not just understanding this, but deciding what type of institution you want to apply with versus going online and applying with the first bank or lender advertising you get. That's literally the very first mistake in this whole process or step, but I say mistake that most people make because they don't know a difference. And because they don't know a difference, they just apply with whoever and then they get a yes or no. And they do that a couple of times. And a lot of times what happens is they end up applying with 3 banks. So they had their credit pulled 3 times and they got the same service. No, no, no. They never got a how. They never got an alternative solution. They never got a yes. And here, like I mentioned, we're going to tell you how. Also, as I mentioned, for those of you that are just joining us, because I think we had someone else just joining us, Ernstine, anyone else that's just joined this group, remember, if you want to go ahead, you have personal questions, you want to meet with me, my co-host Fernanda is going to drop in that chat box our booking link. So you can go on there and schedule a one-to-one directly with myself. And I could talk to you about what's going on in your life, what your goals are, even if it's a year out. So you know exactly where you stand and what you have to do to make sure you can be a homeowner one day and stop renting. So what's the next thing? What do you have to do to be ready to apply? So the next thing we want to do is understand some terms. Again, terms are so important. And one of the biggest terms we want to make sure we're understanding is the word eligibility versus qualification. Why do we want to know that so much? Because eligibility simply means that you're eligible to apply for. Okay? That you're eligible to apply for something. It does not actually mean you're qualified. Thanks, Jessica. Another ace. Love it, love it, love it. Ooh, and I got clapping hands. Woo! So on eligibility, I know what. Have any of you ever seen a commercial or an advertising that says, hey, get a pre-approval letter in 10 minutes or less, or get approved in 10 minutes or less? Another ace. Thanks, Joseph. Sorry, I get excited. I got to make sure I don't ruffle the mic too much. You guys will get a lot of feedback. But have any of you ever heard that? Yes, especially on, I'm going to take that YT stands for YouTube. I am so bad with acronyms. So why am I saying that? Those 10-minute pre-approval letters are all based off eligibility. There's no physical human way someone can actually issue you a true qualified letter unless they've actually done a hard credit pull, looked at your documents, or any of that. Sorry, I'm laughing at Jessica that she put YT, but yes, she confirmed it with YouTube. Yeah, those 10-minute letters of getting approved, that's what that's based off. Why am I saying you want to know this? Why am I bringing this up? Because this is the second biggest mistake I see people make that's going to cost them thousands of dollars, or even worse, lose the house that they wanted. Why? Because, well, what it means is that you applied online, and in their little AI algorithm, auto approved, meaning it said, oh, you meet all these eligibilities, and it spits out a letter. Let's say it spits out a letter for $400,000. That letter doesn't specify terms, which we'll talk about. That letter doesn't specify interest rate. And that letter, more importantly, they haven't actually looked at everything. But here's what's more important for you is you're going to get excited. You're going to go look for homes because you're like, ooh, they said I can buy this. Then you're going to find a home. You're going to get under contract. Here's the thing. When you're under contract, it's legally binding. So if you put a deposit down, if you pay things, most of the time you could that money is up for stake. You could lose it. It's not properly protected. And what happens after that? You go back to that bank. Now you actually get on the phone with someone, or more important, maybe the letter had instructions. Email your contract here. And now someone finally calls you. For a moment, I'm going to go back to they gave a letter and you didn't talk to anyone. They're playing the numbers game, guys. They're just doing numbers. Next. And depending on how many letters they spit out, depends how many contracts they're going to do. Right? I'm laughing at Valentine. It's like if you live in Orlando, you have a heartbeat and you're over 18, yeah, you're approved. Yeah, that's how some of these letters are. You're absolutely right, Valentine. That's exactly what I'm saying because they're playing a numbers game. But the worst part, man, is that they're playing with people's money and lives and emotions because you think you can buy. And then they say, oh, yeah, by the way, I need all these documents. And you're thinking, oh, okay, that's normal. And you send it in. And then they call you back a day, two later, a week later, and they're like, oh, by the way, you're actually only approved for 300,000 or for 350. And now you need 50 grand down or 100 grand down. Oh, and the interest rate's going to be 8%, and everything changes on you. This is why I'm not a fan about eligibility. Jessica, I am going to answer that question. Promise you. Okay? How do you know the difference between eligibility qualification and how to play it smart? We're going to answer that. So then qualification. So now you guys understand why eligibility letters suck. Now, do you want to know what you're eligible for? Absolutely. That's actually the first step. So to answer that, that is the first step is figuring out what you're actually eligible for. And the way we're going to go ahead and do that is going to be doing the way we do it. It's a soft credit pool, getting on the phone, having an interview about the actual things we're going to fill out, and have a detailed explanation on eligibility. And then based on what you're eligible for, the way my team and I handle it, is we're going to then say, look, you're eligible for X, Y, Z, right? Meaning you're eligible for this program, these down payments assistance for this amount, which means you're going to need this much money saved. You're going to be able to buy this much house. And you're going to say, awesome. Elgin, you're crazy. I can't buy anything for that amount. Or I guess that might work. Or never mind, right? Any of those answers. But more importantly, now that we know what you're eligible for, if it's anything but awesome and excited, then we're going to talk about, well, what's wrong with it? Is it too much down payment? Is the interest rate too high? Is the payment too much? Right? What's going on? What aren't you excited? Oh, are you not approved for enough house? And now we can talk about how to get where you want to get to. And let me be clear. The how part, sometimes it's very simple. Other times it's going to suck. I'm just going to tell you. Sometimes I'm going to give you a how and it's going to suck. But the most important part, it's not the second part. I know that's funny, but it's that now you at least know how to get there versus a straight no, versus no way to get there, versus not a clear path. We call this giving you a clear mortgage plan. And that's my goal, is to do that. And I'm going to tell you, we've helped hundreds and hundreds, actually probably thousands at this point, of families do this. Some of those have been a couple months, sometimes literally a week. I have a family, it was 4 years of working with them on making all these changes until they were able to buy the right home. So that's why eligibility is so important. And once we know we're in a place where we're eligible for what you're looking for, then we actually harden that or finalize that by qualifying. And what does qualification mean? That means you allowed for a hard credit pull and you submitted all the proper documentation for it to be reviewed with the bank, with the lender. And as long as nothing changes on your end between the time that they give you that pre-approval and closing, nothing should change on you. And qualification is absolutely key before you go truly shopping. But again, we start out with that eligibility. So Jessica, I hope that gave you a little bit better path. I'm going to answer even more about this as we go through the process on things to look out for. Like I said, my goal in today's class is to teach you what to be asking, what to look for, how to understand this. Knowledge, not just information. Well, it's useless if you don't know how to use it. So let's get into the first thing you should know. You should know two things now. You should know credit score. So for credit score, the very next slide is one of my favorite slides because we're going to talk about why every single time you apply somewhere for something, it's a different credit score than what you see. And then two, we got to really focus on your income and your expenses. Now, when we talk about your income and expenses, I tell people you got to understand your income and expenses in two ways. Why do I say two ways? Well, there's the real world. When I say the real world, the real income you bring home. Why do I say the real income you bring home? Well, let's say you were making $60,000 a year. Well, you don't actually bring home $60,000 because they hold back on, well, federal taxes, income taxes. Then you got to go ahead and pay for maybe healthcare, very likely. And maybe you also have, childcare, and who knows what else you have to pay for. That's very different than the way we look at it. When we look at your income, we look at your gross. So we look at your income before they deduct federal taxes, Social Security, healthcare. We don't even count that against you. But then what we do focus on is what's on your credit report and not how much you owe anything. What is the minimum monthly payment that you have to make on each item to make sure your credit stays good? So for example, if you had a loan that was $100,000, I know I'm being a little ridiculous, but that's the point. If you had a loan that was $100,000 and the minimum payment was only $100 a month, guess what? You only got to pay $100 a month. That's all we're going to count. Oh no, Jessica, you got to go on me. Yes, Jessica, I'll send you a booking link, okay? I'm going to text it to you, okay? And then hopefully you can go ahead and maybe book a one-to-one with me and we can talk about it. And then from there, we're going to go ahead and look at your debt and all those minimum payments, as I was saying. So I talked about that example of minimum $100 a month. We'll go to the other extreme. Let's say you have a debt that you only owe $7,000 on, but the minimum payment on it's $500 a month. Unfortunately, even though you owe $7,000 only versus the other one that you owed $100,000, we're counting that minimum payment of $500 a month against you because that's the minimum agreement to stay there. Yeah, I hate it too. We're all going to miss you. Mucho hearts. But thank you for joining. Great questions. Let's talk tomorrow if you can, or book a one-on-one with us, okay? Have a good one. So that's what we're going to focus on, is those different incomes and assets. Sorry, guys. I know I keep going back and forth. I get involved. I enjoy having so many people on. Also, I'm in the office by myself at 7 o'clock at night talking to a camera like a wacko head. So it happens. But let's jump into this credit score stuff, all right? So credit scores. Thank you, Lisa, for understanding and giving me smiles. I know we all know that we have 3 different credit scores, right? Experian, we should see my mouse come up, Equifax, and TransUnion. But did you know below those scores, you actually have a total of like a little over 30 different credit scores? Any of you? Any aces? You guys something new? Well, here's why. Well, I don't know about the why, but why are there so different? Well, there's different versions. There's different versions, okay? Depending on what you're applying for. Ace, ace, woohoo! Still getting some aces. Thank you, guys. All right. So here's the first part you should know. If you're looking at your credit score on any application, especially those free ones, like your banking application or anything like that, when you're looking at that credit score, the very first thing you should be doing is reading the fine print. And in that fine print, what you should be looking below is it's going to tell you if it's Experian, Equifax, or TransUnion. That's the first thing. The next thing is going to tell you it's either going to say the model, the version, or something in these words. And then it's going to tell you FICO score 9, FICO score 8, FICO auto. And what that's telling you is telling you which algorithm of all 30 algorithms it's actually using. Valentine, Joseph, Ernstine, thank you. Ooh, and Lisa, thank you for all the aces. Yeah, this is important stuff, right? Because here's what's actually happening, guys. 99% of the time, when you apply for something, you're probably going to be looking at like an Experian score, FICO score 9, because that's typically free. And for example, when you apply for a mortgage, we're over here pulling these different versions down here. And the best way I tell people to think about it, it's a different algorithm that weighs everything differently. Kind of like back in school when you had grades and you studied, you had your regular GPA, but then there was like a weighted GPA and different testing scores that could give you different weights and different grades, even though it's still the same grades and the same information being provided, but yet a different GPA. Same concept, just way more confusing. But this is why you see a different score. This is why when you say, oh, I see that my score is a 650 here, and then you might go apply for something else and they tell you it's a 580, 99% of the time, okay, I want to be very clear, 99.9% of the time, it is not because they pulled your credit. It is simply because they're pulling different data, a different version, not because of the credit inquiries. Credit inquiries maybe will drop your score 1 or 2 points ever. And I use the word maybe because most of the time, it doesn't even drop your score at all unless you've been having your credit checked a gazillion times in like the last 2 years. So it is not a real reason. So this is why knowing your credit score, where you're actually at, but more importantly, which one is being looked at is so key to your success. And where you can actually get access to that, before I forget, Fernanda, could you also drop the website? There's a website called myfico.com. So you guys know myfico.com. Fernanda's going to share it in the chat box. But that website will give you access to all those credit scores. They do charge. I don't make any money for it, but it's like $80 or something like that. And basically you'll get all those scores. And I assure you that if you got all those scores, and for example, we were looking at the mortgage scores, and then you apply for a mortgage, the credit scores are going to come in exactly the same if it's the same date. I use the same date because if you apply a week later, maybe the data changed, a new payment reported, a new balance updated, and that's going to change the score as well. So that's why that's so important. So let's keep going on how to apply the smart way, because we got to get moving on some of these things. It's 7:30, so we're halfway through. So first things first, what do you need? Well, some things sound silly, as I mentioned, but make sure you have your ID on you. Make sure that it's not expired. But most importantly, when you're applying, make sure that when you apply, your name you're using is the exact same name that's on your ID. If you have 20 last names like I do, you have to use all 20 last names. If you have junior, senior at the end, use that. If you have a middle initial, use that. We see applications get flagged, or even worse, at some of these banks or lenders get denied up front because of fraud, simply because your name didn't match exactly to what's on file with your social security number. So make sure that matches. Next, we're going to talk about income in 3 formats. We're going to talk about income if you're employed as a traditional employee, W-2. We're going to talk about income if you work for yourself or you're an independent contractor. And we're going to talk about it if you don't work, or maybe you receive pensions, Social Security, any of these other income formats. So let's start out with employment. If you are employed, they want to make sure that, first of all, you have at least 2 years of employment. Now, I want to be clear. 2 years of employment does not mean 2 years at the same employer. It just means 2 years of employment. So that could mean you've had 4 jobs, 5 jobs, and we just got to be able to track it all. But more importantly, we got to be able to document it all with pay stubs, W-2, or something legitimate, right? Point of contacts helps because then we can reach out and get those verified. But what if you didn't have 2 years of employment? Well, then we got to know why. Were you in college? Were you studying something? And if so, how long were you out of work for? Another scenario we see happen all the time that we can work around, with moms, a lot of times they might take 1 or 2 years off work, not because they want to, but because they're working, raising a child. Well, now you're back into the workforce and you've only been back to the workforce for a year, let's say, or 8 months. Can you apply for a home loan? Yes. We still have to go back in time, 3, 4, 5 years to fill in a 2-year employment history. So that is super key to identify what they call stability, and then we can go ahead and do that income. Now let's talk about self-employed, independent contractors. Independent contractor, self-employed, working for yourself. If we're going to be looking at traditional, I call them traditional mortgage programs like the FHAs, the conventionals, any of the government subsidized loans, it is important that we look at the income on your last 2 years of tax returns. And this is important so we can set you up for success in the future because they will be looking at that net income on there. Or alternatively, let's say you don't want to deal with your tax returns or you haven't filed them, but you have been self-employed for the last 2, 3 years and maybe you haven't filed. Well, we can look at things like bank statements, your last 12 months of business bank statements or personal bank statements on all your deposits. We can look at your 1099s. We can get an actual profit and loss from a CPA if you have one. So there are alternative solutions if you haven't done your tax returns if you're self-employed or an independent contractor. And then let's say you have other incomes. Maybe you're retired, Social Security, pensions, trust money, anything like that, child support, alimony. As long as we can show proof that you're going to be receiving this for the next 3 years, all those incomes are also eligible to qualify for a home loan. Again, key here, document everything. Then we're also going to want to see your bank statement so we can see how much money you have. If you have cash hidden away in a sock drawer or something like that, you're going to want to let us know so we can walk you through how to deposit that properly. Believe it or not, we have to source deposits. There are some ways to get around them, but if not done correctly, it could get your file declined because we can't use those funds. So that's key there. If you already own a home and it has a mortgage on it, we'll need that mortgage statement. So having that documentation is key. But again, you don't need it up front to just get started on that eligibility side. But at the end, as I'm saying, is you want to get fully pre-approved. Pre-approved means actually qualified. You turned all that in. You had your hard credit pull done. They reviewed your actual credit report with you. Do not just get pre-qualified. Pre-qualified is based off those eligibilities. That's going to kill your deal. And as I tell people, don't work with a website. Don't go online and take a letter. You want to talk to someone. You really want to talk to someone to understand what interest rates are going to be offering you, what your payment's going to look like. How long is the loan for? Is it for 20 years? Is it for 15 years? Is it for 30 years? Is it for 40 years? So talking to a professional before you even go look at homes is key. And here's the more important part. Once you've done all this, you're going to understand all your options. And we're going to get into this here as we're getting into the second half of that. We're already in the second half of this, but we get towards the end is we have a mortgage, but inside a mortgage, we have different loan programs and loan products. And that's going to be the key to success is which product or program are you actually being qualified for? Because it is not a one size fits all by no means. And during all this, don't make any major moves, right? Don't quit your job. Don't go ahead and buy a new car or truck. Don't overspend on your credit cards and max them out. If you have to, or if you might need to, sometimes you might need to get a new job offer. It might make sense. Let's talk about it. Because sometimes it's okay. Sometimes it's not okay, especially if you're going into a variable position like all commission. It could create issues, delays. So we got to talk about them. But opening up new furniture, my credit cards, stuff like that, do that after you buy the home. The home needs to be the priority. So you're not renting anymore. And of course, ask plenty of questions. And I tell people, if you're asking questions and they're getting frustrated and they're not answering them, or maybe they're avoiding them. I had a scenario literally like 2 days ago where I had a client call in, frustrated as could be. First time they called in, frustrated a bit, can be, what's your interest rate? What's your interest rate? I started asking quick questions. I answered them what the interest rate they would be eligible for was. They're like, oh. And then they calm down, like, okay, can you tell me what's going on? Their answer is like, I've been working with another bank for 2 weeks and they can never tell me what the interest rate is. Like, that's a red flag. Yes, right away. I said, we got red flags in mortgages, right? No different than you get red flags in dating. Run away, go the other way. Because you got to get someone that's going to explain everything. I'm glad Lisa likes that reference. Oh, I went too far. There we go. So earlier I mentioned, as I was talking through things, that we want to understand home loan or the word mortgages versus loan programs and products. Okay, so this is key, okay? Because this is going to be one of the, remember, I'm going to teach you questions to ask that you want to be able to ask and get a very direct answer. So when you're figuring out what you're eligible for, you want to know what loan program or product you're eligible for. Why? Well, the word home loan or mortgage, it's a very general term for funding for a home. Doesn't mean anything. What I mean, it doesn't mean anything. It doesn't tell us terms. So think of the word home loan or mortgage like the word vehicle or car, right? Vehicles and cars, it's got 4 wheels. Sometimes it has more wheels, sometimes it has less. It's got some type of engine. Maybe it's diesel, maybe it's gas, maybe it's electric. Some type of steering wheel, right? But it doesn't mean any specific type of vehicle or any type of car. So you don't actually know what it's, what it drives, what it looks like, what it feels like. You just know it gets you from point A to point B. Well, a mortgage does the same thing. It gets you funding for a home and gets you from point A to point B. Same idea. So the very first question when someone says, hey, we are able to pre-qualify you, or we are able to pre-approve you, you should be asking, well, I say be nice, be generous, be like, awesome, thank you. But what type of loan program am I qualified for? What type of loan program am I eligible for? Could you tell me the details about the loan product? And then when they tell you, if they only give you one, you should ask, are there any other products or programs I'm also eligible for? Right? Why do you want to know that? Because the loan program or product that you qualify is going to determine the following factors. How long is the financing for? 15 years, 20 years, 30 years, 40 years? How much you need a down payment? No down payment, 20% down, 50% down, 3% down? Is your interest rate fixed, variable, interest only? What else? Ooh, does your payment include taxes and insurance? Or is it just the payment with no taxes and insurance, so you still have to pay that outside of the mortgage? All these details are going to be included once you know what loan program or product you qualify for. And then if you are eligible for either one or multiple, then you want them to give you examples of how that actually portrays. And I actually, on one of the slides, will show you what I mean by that. Another question is, does it have prepayment penalties, right? This is all going to be under that loan product or program. And what determines all that? Well, as I mentioned, eligibility really determines what programs or products you're eligible for. Things like your credit score, occupancy. Are you going to be living in the home as your primary residence? Are you going to be using it as your investment home? Thank you, Joseph, for the ace. I was thinking I stopped teaching you guys something. I was like, whoo, I've gone too many minutes without an ace. I was getting worried. Household size, income, believe it or not, down payment assistance, total household. Lisa, thank you for the support. Woohoo, another ace. All these things will determine what programs or products you're going to be eligible for. I mentioned earlier as well, kind of dropped a hint that we'll talk about down payment assistance. Some of these items, most of these items, all determine that as well, meaning what you're eligible for, what you could apply for. So how do you know what type of mortgage program is right for you? Well, first off, the easiest way to know is I plug it in here, and it's book a one-to-one. Fernanda's going to drop that link. jump on a call with me, and we can really determine what the right mortgage program is for you. That's going to be the best way to do it, right? But the reality is that there is no one answer. This is the best program for every person, because sometimes the best program is the one that gets you approved. Sometimes it's actually comparing them because you're eligible for multiple, right? So we got to ensure that part of it. And what type of programs are out there? These are just some of them. But you have conventional, you have FHA. DPA stands that you can combine them all with down payment assistance, VA loans for veterans or people currently in the military actively. And then you have this whole suite of unique loan products called non-QM, non-qualified mortgage, or non-qualified mortgages, meaning they don't qualify for traditional terms under the government. And inside of these, again, all those different things I was talking about, like your income, your credit score, will determine your eligibility on what you can do. But this is why you really want to know which program, okay? This slide I'm showing you guys right now, let me grab my mouse. Okay, there's my mouse. This was about a month ago, a client that came to this webinar that went ahead and used our services, something that we were able to do for them. But here's how knowing and getting this information up front is so key. So they were eligible for an FHA loan, okay, which is right here. They were also eligible, and let me be clear, they actually qualified for these. They qualified for the FHA, and they qualified for the FHA program with a $10,000 assistance from the state of Florida, okay? And they found a home that they really liked that they're in now for $350,000. So one of the things you should know is that on an FHA loan, one of the requirements is that 3.5% of the purchase price must be put down as the down payment. So 3.5% of 350,000 would be $12,250. If you look at over here on option 2, we're not going to look at option 3 yet. I'll tell you guys why in a moment. It says you only need $2,250. Well, it's not that you only need that. That's the only portion the client had to put out of pocket because, well, the state of Florida was putting 10 grand. So the loan program itself still requires the 3.5% down. It's just a matter of who's paying for it. And so you're probably wondering, well, why would anyone ever want to go with the first option then? Here's why. Because when you go through the first option, guess what? We're able to shop different banks, different lenders. I mentioned earlier, as a broker, we're able to shop over 100 different banks and lenders. And so we were able to get them a rate at the time of 6.25%. But the moment that they use the down payment assistance program, we have to go ahead and use the bank that the state of Florida has assigned us. They have one bank that they're allowing us to use, that they set the rate, they set the market, they set the terms, because, well, you're borrowing money from them. One, the 10 grand is not free, but it is at 0% interest. And then they go ahead and move it up to 7.25% in this scenario. Now, same thing, just like the market, these rates are changing all the time. These are not the rates that would apply to you or to today's scenarios, just to be clear. So, okay, so what happens now? Let's keep on going down. We'll go down quite a bit to where it says total payment. So if they went with the option at the 6.25, their payment, including taxes, insurance, HOAs, everything, was going to be $26.79. Now, I want to be clear with everyone. They were already paying a little over $2,700 a month in rent. This is very important based on the information you need to know based on why they made the decision they made. Because if they went with the down payment assistance, their payment was going to be $29.35 a month. Now, I said 3.5% is only the down payment. Well, then you have closing costs. So in this first scenario, before any negotiations, once you add the down payment, the closing costs, everything, they needed $25,670. Guess what? They didn't have that money. I already knew that. They came to my webinar. We had created a game plan. They didn't have those funds. So why in the world are we showing them this home? Well, with the $10,000 assistance, now they only needed $15,670. Guess what? They didn't have that money either. However, again, we knew this. So we strategized for them on how to negotiate, paired them up with a phenomenal agent locally in the area that they were looking at. And that agent was able to get them a $10,000 seller credit. And we paired it with that $10,000 assistance. So yes, they took on the little bit higher payment. listen, in their head, they were already paying $2,700 a month in rent. Couple $100 more they own now. And we were able to get them into the home with $5,600 out of pocket total, saving them $20,000 up front to get into a home. That's a massive savings today. And most importantly, now we're coaching them, and we have already coached them on what they need to do. So in about 12 months, we're going to be able to refinance them to get them out of this loan and lower their payment, something that you're not doing if you rent. This is why picking and understanding your loan programs and products is so key. If they had gone to any other bank, I'm very confident that they would have just shown them this. They probably would have been very discouraged and said, we can't buy. And even though they maybe got approved, they would have not bought, because this is like not getting approved when you don't have the money, and got nowhere. So understanding the product, the programs is so key to success. As I mentioned, it will save you thousands of dollars. In this case, $20,000 up front. So that's what we're able to do. Lisa, Joseph, thank you so much. So how much down payment do you guys need? What do you need? Well, again, to get to the nitty gritty, I'm going to tell you, book a one-to-one, and Fernanda's going to go ahead and send that link. But the reality is, it's going to depend on the program you qualify for. Each program, whether it's conventional, FHA, VA, it's going to have its own requirements. It's going to give us the terms. It's going to tell us what credit score. It's going to tell us a bunch of other things. But then, can we pair those up with down payment assistance? Because simply because the program requires it, doesn't mean the money has to come out of your pocket. As you saw, we were able to negotiate $10,000 in seller credit. So the seller paid for 10 grand of the closing costs. The state of Florida paid for 10 grand of the down payment. They only had paid the difference, what it didn't cover. So things to know about down payment assistance programs. These are very important. The definition of a first-time home buyer, so important that you know this, is simply someone that has not owned a home in the last 3 years. So if you owned the home before and you sold it more than 3 years ago, you're eligible. Credit scores, that matters. Different down payment assistance programs have different credit score requirements. Understand there is way too many down payment assistance programs for me to sit here and talk about them. Each county has one. Each state has them. They have several of them. Counties have several of them. Cities have several of them. And then above and beyond that, certain banks and lenders, as you'll see here, will offer them. Now, one of the things that I will focus on is I'm going to focus on not just which ones you're eligible for, but of course, more importantly, which one can you actually qualify for? And even more important to that, is there actual funding left? Okay. The reason I say that one is the city and the county websites, they're government entities. So you can imagine they're not sitting there and updating their websites daily. Sometimes not even monthly, sometimes not even but once or twice a year. So their information on how much funds they have, from my experience, 99% of the time is completely inaccurate. And so we have special phone numbers we call to verify, is there funding available? Is there not funding? If so, for which programs? So we ensure that the money will be there by the time you close. We never want to set you up for failure. We want to set you up for success. So that's another key here. And again, these are just some of the enterprises or companies that will offer some of these programs above and beyond just the counties and the cities. One important thing to note, you can only use one down payment assistance programs at a time. Till this day, I have not found a single one that allows us to pair or combine multiple of them at a time. So please note that, because I know that's a very common question I get asked every single time we do these webinars. Now we're getting almost to the end, guys. I still have a couple of you guys here. Joseph, thank you for the ace. Now tell me, guys, how are you feeling? How are we feeling? You feeling better? You feeling less stressed out? Feeling good. Awesome. Lisa, Monique, how are you guys feeling? Valentine, you feeling better after today's class? Absolutely, Lisa. My pleasure. So I mentioned that was the goal tonight, is to do that. I really appreciate you guys coming. Now, we're not done here, right? Almost there, guys. Stick with me a couple more minutes. Now that you have all that information, as I mentioned, we're here to help. I'm here to help. Book a one-to-one if you truly want to go ahead and be a homeowner anytime in the next 12 months. If you want to be a homeowner in the next 2 years, 3 years, book a one-to-one with me just so I can say hello to you and get to know you so I know who you are in the future. Okay, when we book that one-to-one, here's your job. Tell me what you really want. Let me and my team do the heavy lifting. Let us do the figuring out the jigsaw puzzle. That's right, Valentine. Just click the link that Fernanda's sending out. She is sending those links. All you gotta do is click on it. It's gonna give you times and dates that you'll be able to speak to me personally. So I can get started. I know what to do, and then my team will take over and handle the rest. Well, let us do that, guys. Even if it's ridiculous, right? That's okay. We want to help. I've told you, I've been with a family for over 4 years before we got them into a home because that's what they really needed to get to them. Okay. And that's okay. I'm happy to do that. What's that right order and do this? Well, as you notice, it's picking the right team. Step number 1 is picking the right team, picking the right institution, the right lender, the right loan officer. If you're financing, that's step 1. If you're not financing and you're paying cash, avoid me entirely. Go directly with a real estate agent. But if you need financing, step number 1 is picking the right lending team. What institution do they work for? And are they right for you? Are they the right fit? Once you pick that right team, jump on a one-to-one call with them. Don't go online. Speak to them on a phone call or on a Zoom meeting and apply for your eligibility. They're going to do, well, let me tell you what we're going to do. We're going to go ahead and do a soft credit pull. Again, doesn't count against you, but that's going to allow me to see everything. And by doing that soft credit pull, asking all the questions that we need to ask, I'm going to be able to tell you exactly what you're eligible for today. So then you can tell me, awesome, that sucks. But more importantly, then we can create a clear mortgage plan for you. And we can make any adjustments with plenty of time, not at the last minute, not 2 months before your apartment lease is up, to set you up for success. And then once you're fully ready, we're going to start running some real life scenarios. Remember how I showed you that screen with all the different loan options for that client that recently used us? We're going to do the same for you. You're going to send me addresses. We're going to send you examples. We'll jump on a Zoom meeting. We'll jump on a call, teach you how to read it for your scenario. And then once you're fully ready, you're like, okay, I'm ready. We got this. I'm at where I need to be. Then we're going to get pre-approved. Do the hard credit inquiry, get all your documentation, make sure nothing's going to change on you. And at that point, you hook up with a real estate agent and you start looking at homes. And then you find the home you really want. We're going to negotiate as hard as we need to get the terms that you need that are favorable to you. Okay? Until we get you under contract. And from there, we get to the home stretch. Typically, we close within 30 days after that. And you've got your keys. You're in your new home. That's all it takes. And you already did the hardest part, which is joining a webinar, honestly, so you can gather information. Step number 2 is booking that one-to-one. Okay? There's also the QR code. Fernanda's going to keep going ahead and sending that. But most importantly, as I mentioned, I'm here to help you from getting stuck. I'm here to stop you from getting frustrated. And here at Ace Lending Group, we're not going to tell you no. We're going to tell you how. Thank you guys so much for joining. I'm going to go ahead and stick around now. That is my presentation of tonight. I really hope you guys book those one-to-ones. If you have questions, I'm sticking around answering any Q&As you might have. Absolutely, Lisa. I really look forward to talking to you. Hopefully, you're able to book one of those one-to-ones with us. Joseph, Monique, Valentine, really hope you guys book those one-to-ones. Absolutely, man, my pleasure. And guess what? I got done with 3 minutes to go. Woohoo! Right on time. Fernanda, told you I'd meet the time. If you guys have questions, I'm sticking around though. I'm not going anywhere. If you don't have questions, book that one-to-one, even if it's just to say hello to me. That's okay. I want to get to know you. I want to know what those goals are. I want to know how we can get you there. Like I said, sometimes it's quick and easy. Sometimes it's time consuming. I spoke to someone earlier today. I mean, they're going through divorce, they're going through things, but that's okay. I was able to tell them, look, once you go through your divorce, here's what's going to happen next. Here's what you need to do next. And here's how much you're going to be able to do. And they were happy. They're like, oh, wait, that's it? I was like, yeah, that's it. And now they know. So now they just have to wait for that to be over. A couple months. That's what they told me. And they're ready to go. But they have a clear mortgage plan on what it's going to take to be a homeowner. And they didn't think they could buy, honestly. They told me that. Dude, there's Valentine. Is there still time to finish the year on a house? Absolutely, man. You could be in the house. I just got a contract today. We're going to be closing before Thanksgiving, okay? We're going to have a couple more deals, I'm sure, that will close before Christmas. Even a couple more weeks from now, still closing before Christmas. So we're going to be able to make it happen. So again, book those 1-to-1s. Really want to get to know you guys. Really want to get to talk to you. Really appreciate the time you guys gave me. I will be sending the recording out again, just in case you missed something, you want to rewatch something. And I'll also, if you missed the booking link at any point, I'll make sure that you get a text of it here in a little bit, okay?